So our currency of the week is euro-dollar, the world's most popular currency pair. It has fallen to a 14-year low so far, but we're closer to parity. The biggest driver here is monetary policy divergence. Basically, the Fed is raising rates, the ECB is printing money. Parity is certainly an option, but I would say watch out for the trade balance, and I would say there's also a limited window for parity. We'll talk a bit more about that right now. So let's talk about monetary policy divergence first. Why I think parity is a possibility. On the monetary front, we see here ECB President Mario Draghi. The European Central Bank, in its meeting in early December, extended bond buying through 2017. Until the end of 2017, the European Central Bank will buy bonds, and it has the option to extend it even further. Okay, from April, they're buying only 60 billion euros per month instead of 80, but from January, they're allowed to buy any kinds of bonds they wish. That means also short-term, 1 year German bonds, which have a negative yield of minus 60 basis points, minus 70. So far, they were limited by minus 40, which was the negative deposit rate. Okay, so now they're unlimited. And then the forecast they've shown that inflation is not expected to improve through 2019. So looking 3 years into the future, and with all their monetary stimulus, they're not really optimistic. Okay, so the ECB is very dovish. In addition, we have political worries in Europe. So here's Angela Merkel. That's the last major election. That's in the autumn. Biggest event is Marine Le Pen here on the bottom right corner. Elections are held on in two rounds, April 23rd and May 7th. Okay, there's a real chance that this far-right candidate will win the French presidency. That will be a huge earthquake. Also elections beforehand in the Netherlands, and with this attack in Berlin, we should also watch out for Germany. And markets are also more worried after Brexit and Trump, okay? Italian banks, I believe the story will be resolved, but it's an ongoing story. And Greece can always return to the limelight. Remember, there's a can-kicking exercise, and it has never been resolved, okay? Greece is in a Great Depression. The economy shrank by 30% since 2009. Okay, so bad stuff from Europe in general. Monetary and fiscal. Moving to the United States of America, at the moment, there are still high expectations from Trump to enact tax cuts and infrastructure spending. In addition, there is hope that for more economic activity in the United States could last through the inauguration. The inauguration is on January 20th, a month from now. Okay, last month for Obama in the White House. And he promised to do a lot of things, Donald Trump, on day one. He'll be fully assessed after 100 days. That's sort of the traditional. They say that what you do in 100 days, you can't do later on. That's, of course, a bit of a legend. Trump or any other president can do lots more in the full 4 years, but sort of the political capital, the political mandate is stronger in the first 100 days. So I would circle late April as a time to assess Trump's presidency, at least the beginning. Remember that Obama pushed the stimulus package, nearly 800 billion US dollars, in the first 2 weeks of his presidency, and that helped stabilize the US economy. That was a huge move. And regarding the Fed, of course, the Fed did the unprecedented move of upgrading their forecasts, okay? They shifted up, GDP by 0.1%, but more importantly, the forecast for their rate hikes. Now, I don't think they'll raise rates 3 times, but maybe just 2. But just being more optimistic on the economy, instead of downgrading the forecast, that's a big thing from the Fed. And it's based not on Trump's promises, that optimism from the Fed, but on the current data, on a good jobs environment, on rising inflation. And of course, if Trump really provides fiscal stimulus, they'll raise rates more quickly. So we have a big divergence between Trump and Yellen on one hand, and Draghi and European politics on the other hand. So all this should push euro dollar lower, right? So yeah, here we are, the conclusion. Here is the parity image. Okay, Europe, and political uncertainty and dovish central bank, and in the US, perceived political certainty. Well, elections are over, but we have lots of uncertainty, and a more hawkish central bank. So I believe euro dollar could continue falling in early 2017, but that's a limited window. Let's talk about where the euro gets its support from. Okay, you see that when nothing happens, like tonight, or when we have no news, no developments, euro dollar rises. Of course, not every time, but this happens. What's going on? It's the trade balance. Sort of the basics of Forex are back to haunt us. So the Eurozone has a huge current account surplus, huge trade balance surplus, thanks to German exports. Okay, it's around 25 billion euros per month. On the other hand, the United States has a big deficit. Okay, so this is quite different from previous US dollar rises in the past. You can see many comparisons to, I don't know, periods in the 1990s, 1980s, 70s, whatever. But these comparisons are limited because of the trade balance. What does this trade balance mean? What it means that, in general, Europe is exporting more than it is importing. So when you have more income from the outside in US dollars and whatever currency to the Eurozone, you have to change it to euros to buy euros. That supports the euro. In the United States, they have a deficit. That means they have to spend dollars to buy more stuff because they import more than they export. And of course, when we have news, we have speculation. Speculation is king. But we don't have it, when we don't have any news, we see these forces of the trade balance, which have been quite stable in the past few years. This could, of course, change, but in the past few years, these trade balance gaps have been stable, and this keeps the euro supported. So what I'm saying is the moves are limited. There is a window now. If we don't have, I say that euro dollar could rise in late April, early May. If François Fillon, I hope I'm pronouncing his name more or less correctly, the guy here in the picture, the center-right candidate, wins the French presidency, he's the leading candidate, a mainstream candidate, more or less, not Marine Le Pen, and that Trump does not meet the sky-high fiscal expectations, and it'll be quite easy for Trump to miss the expectations he created. We'll have some disappointment from the US, some optimism that populism has peaked in 2016 and 2017. We'll see, I don't know, comeback of mainstream or at least some stability, and then we could see euro dollar rise. First reason, thanks to the trade balance, and the second reason, sort of push back a correction after the huge move. So I can't see far into the second half of 2017, but for the first half, I would say euro dollar could suffer in the first quarter and make a comeback in the second quarter. Okay, and let's conclude this segment for those watching the video with a quick roundup of just a few levels that I'm watching here on euro dollar. Currently 104.04, resistance 104.60, the March 2015 low, and then the December 2015 low of 105.20. Higher above, we have, well, 108.60, 106.60, and 107.10. On the downside, we have currently 103.40, which was an important line back in 2002, then 101.50, and then, of course, parity. Below parity, let's get there, and then we'll talk. Okay, so that concludes our euro dollar segment.